The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Signs of market calm, devoid of market conviction. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. God, can't get my words out today. We're kicking off to the closing bell here in the U.S. All right, let's take a look at what's going on in markets right now, because positive earnings from the banks not doing much to make up for the ongoing tariff uncertainty. So you see the S&P 500, and in fact, all the other major indexes, little change now after two clear up days. Now, yields are decidedly lower for a second day as bonds extend yesterday's relief rally. And speaking of relief, the dollar finally ending its 5-day losing streak. The dollar index up about 0.33%. Let's take a look at NYMEX oil drifting lower right now, down about 0.2% on expectations of an oversupply of global oil. We'll talk about that a little bit later, Romaine.
Yeah, in fact, though, I want to go back to April 7th, Scarlett, here. When we had that intraday low on the S&P 500, we've actually bounced 12% off of that intraday low. But as you can see on the screen that Scarlett had up, that rebound rally really appears to be losing some steam on what is a relatively calm trading day, we should add, in an astonishingly calm holiday shortened week. But part of the hesitation may be technical, with that 50-day moving average crossing below the 200-day moving average yesterday. It's a chart pattern cheekily referred to as the death cross, and it's often a harbinger of a deeper downtrend for stocks. Not helping matters is the latest fund manager survey out from Bank of America, which showed that 61% of clients actually expect the dollar to depreciate over the next 12 months. 82% expect the global economy to weaken, and a record number of investors in that survey intend to actually cut their holdings of U.S. equities. In fact, when you take a look today, European stocks outperforming the U.S. for a second straight session. Now, it's not all gloom and doom out there. Fantastic earnings from Bank of America, decent earnings out of Citigroup, along with the news report of a potentially strong growth outlook for Netflix, which reports in a couple days. That's providing some assurances, at least for now, that some companies are well managed enough to navigate through the current storms. A lesson that, at least from a bottom-up perspective, there is maybe value to be found, Scarlett, in the aftermath of that big sell-off.
All right. And of course, value may be easier to spot now that the broader market swings have started to mitigate. Volatility for stocks, you've got the VIX here in blue, and in bonds, the MOVE index is in white, really began ramping up in the days leading up to President Trump's so-called Liberation Day. And then you had the deep sell-off in both stocks and bonds, really sending these measures soaring on Tuesday to the peak, in fact, on that day. To be fair, you have below average volume thanks to a holiday shortened trading week here in the U.S., and that may be distorting the declines that we're seeing here in VIX and the MOVE indexes. Both measures, of course, are still elevated relative to their year-to-date average. So, Romaine, it may not take very much to trigger just another spike up.
Absolutely. As we kick you off to the close on this afternoon, let's bring Aaron Dunn into the conversation, co-head of value equity over at Morgan Stanley Investment Management. Aaron, I take it you've got to be a pretty popular guy these days, because this is not a macro-driven market, at least not at the top level, at least to the upside, I should say. But certainly from the bottom-up perspective, you are seeing people search for, I guess, bargains. Can you find them right now?
Relative bargains. I think the challenge is what we've seen to date is really a broad-based sell-off in the market based in our view that people were very fully invested heading into the year. We expected a lot of volatility this year, and we got more than we expected. So it's been a massively volatile market, a lot of bigger picture sort of deleveraging, and we think flows coming out of the market. So everything was very uniform in how it was treated. We think earnings season it's a very quiet day. Earnings season's picking up. The banks who are not really impacted by tariffs are going to be the ones. The outlooks were relatively benign. They kept guidance for the most part. But it's going to be the rest of the earnings season. I think that's going to be very telling. The projected consensus estimates for 2025 earnings are still for 10% growth. That's trending lower. We'll see where that goes. Who pulls guidance, who doesn't? That's going to really create a lot of stock opportunities in our view.
I am curious, though, too. I mean, it's funny you mentioned the banks. Obviously, they're going to be much more insulated from some of the tariff impact. So maybe once we get deeper into earnings season, the tone is going to be a little bit different. With regards to that tone, though, Aaron, do you think it's going to be temporary, meaning that some of the pain and some of the navigation that these executives are going to have to do to keep their companies afloat, is that something that, okay, is a 2-quarter story, or are we now talking about a 2-year or maybe even longer story for them?
Well, I think we've had the first sort of shot over the bow, so to speak, and The management teams have largely been thinking about this longer than we would think, right? So they've been considering what they're going to do. The goalposts keep being moved, so that's a big of a challenge for them, and that is impacting sentiment in the corporate suite, right? The management suites of these companies, how they're going to approach the rest of the year is being decided right now. That can always be corrected as things go forward, but we've had a very one-sided conversation so far, and that's very tariff-centered. There's a lot of other things going on we think could be incremental positives, such as taxes and so forth. We think that's coming. But we have had the first shot. And so, it's going to be interesting to see how companies approach this. You've seen one company that didn't give guidance. They pulled guidance for the year because they just don't know. And so I think that could very well be the case this year. I also think there's a lot of companies who have been really hit with a broad brush of tariff impact that we're going to find out that there's ways for them to lower that impact within their business. And I think that's going to be the relative winners here. And
that will take some time for them to sort out before they can share it with investors as well. You've mentioned that heading into 2025, you took a lot more cyclical risk out of your portfolio, anticipating this bout of volatility. So what was the last week and a half like for you? Were you loading up on some of your purchases that you had ready to go? Were you kind of more willing to sit out until you get more clarity from companies during earnings season? What did you do?
Yeah, so the saying is, right, the deck has been reshuffled here, and you've got a lot of stocks that we really like the fundamental stories of, but when you look across the market from an allocation of capital perspective, we have a lot better opportunities that are now available to us. Now we have to manage the risk of that appropriately. Do we understand the downside of the fundamentals that could be coming out? Is it still a good value in our opinion? That's what we're spending our time doing and looking through the market. So we will move the portfolio around based on what the market's giving us. And so we've done that.
Okay, and a couple of the company names that you really like in your portfolio include names like McDonald's and Abbott. Consumer staple, McDonald's pretty much, is something that provides that certainty. Talk a little bit about Abbott, because there's a lot of question marks over the healthcare sector, particularly if there's going to be tariffs on the pharmaceutical side.
Correct. So really both those names are what I would call sort of all-weather stocks, meaning let's own things that aren't going to be swung back and forth on tariff tweets and whatever it may be in terms of the news flow for tariffs. What are companies that we view have solid fundamentals? They're good core pieces of our portfolio. McDonald's is one, as you mentioned. Abbott is another one. And this is one that, it's a med tech company largely. They've got a nutrition business. They've got a couple other businesses in there that we think are very, very good businesses. Coming out of COVID, the pandemic, they had a big testing tailwind during COVID, so they've sort of been lapping that. We think they're about to start to grow earnings again dramatically. We think they've got a great pop on in the med tech business. From a tariff perspective, really the speculation is around pharmaceutical tariffs, right? And so Abbott, in our view, is less exposed to that. Where they are exposed is where our manufacturing bases around the world that they're going to be impacted on tariffs, and how can they move production around to avoid paying, very, very negative tariff rates on that. So we think that's going to come. They report tomorrow. We'll see what they have to say.
I am curious, though, what your general view is, Aaron, right now on consumer spending, specifically on the discretionary side. You talk about McDonald's, Abbott, healthcare, obviously being sort of all weather, if you will. But I also see, at least in the one of the large cap value funds, Eaton Vance funds that you manage here, Disney is a pretty big holding in that as well. Does that have the same sort of buffer?
It does. I mean, it's not, you've got the parks business, which is certainly at risk of coming under pressure from lower consumer spending. The challenge with Disney is that the reason we really like it is they've got really loaded a lot of boats in there. They've got some new ships that are sailing that we think the market is not paying attention to. And so we really want to, that's really why we're investing in Disney. We think the market underappreciates that. They've got the digital business back to being break even or profitable. So we think that's all very interesting. And the stock here looks very cheap to us for what we view as great fundamentals.
Aaron, always great insights. Aaron Dunn, he's co-head of value equity at Morgan Stanley Investment Management, kicking us off to the close here on this Tuesday afternoon, of course, with the focus on the markets and a focus on Washington. The tariff tit for tat sparking a huge sector downgrade over at Barclays. A discussion on why one particular auto stock also got a major downgrade. The analyst behind that call joins us in just a bit.
And speaking of cuts, the International Energy Agency cutting its oil demand forecast for this year by almost a third. We've got a discussion on what potential oversupply into next year means for commodity prices with Natasha Kaneva, head of global commodity strategy at JPMorgan.
And we're going to talk travel too, and whether we could continue to see a softness in that space, particularly when it comes to inbound travel to the U.S. from outside our borders. James Ferrara, CEO and co-founder of Inteletravel, going to be joining us a little bit later on the close as we await earnings out of United Airlines. A lot coming up over the next couple of hours. Don't go anywhere. This is Bloomberg.
Shares of Bank of America and Citigroup on the rise after both firms beat Wall Street estimates, with B of A specifically seeing a big increase in its loan revenue. With the regional banks getting set to report, we want to bring in Alison Williams, senior analyst with Bloomberg Intelligence. And I go to what Mike Mayo, the famed banking analyst over at Wells Fargo, said on one of the calls, which is he's surprised by the upbeat tone among the big five banks. That's right. But I guess this goes to the point of you had a very volatile period. You had a lot of cross currents, and yet the big banks seem to be indicating everything's okay. Is there a disconnect there to you?
So I'll say, we know that the volatility is really in April, right? So the quarter ended in March. So it should have been a good quarter. It was. We did see some volatility at the end of the quarter. Yeah. I think what we were listening for was, what have banks factored into their estimates? So like JPMorgan, they had a big gain in the quarter. So that allowed them to set aside some loss reserves to, they basically took their assumptions to a 5.8% unemployment rate. And that's about similar to Wells Fargo already was. So even though we saw a big provision at JPMorgan, not really Wells Fargo, they're both kind of prepared for the same weighted average economic scenario, if you will.
So what about the other side of the business, though? I mean, the capital markets businesses for all of these banks, really not a whole lot to write home about for the first quarter. Does that turn around anytime soon?
I mean, really, the strength in the quarter was at equity trading. Yeah. And, when you look at what's happening in the markets and some of the comments that we heard from the banks, we expect that continues. I think the big question is we're seeing a lot of volume, record volume in some areas. Does this mean that a lot of clients have deleveraged and there'll be less going forward, or will we still continue to see some of the activity? Keep in mind that the first quarter does tend to be the seasonally strongest, so we would expect some fade in trading, but we do expect trading stays relatively strong, notwithstanding that seasonality. For the year, it's the banking fees.
But the other side of the business, too, because, I mean, when you listen to the commentary, not just today from Bank of America and Jane Fraser at Citigroup, but even on Friday, it's all seemed to be upbeat. And I'm a little curious as to where that upbeat tone is coming from.
Well, because I think it's really just about the risk ahead, right? Yeah. So that's what is driving the volatility in the markets is uncertainty about the second half of this year, right? It's not about this week or next week, but where we'll be. And I think, with on a whim, things could change one way or another. So as that uncertainty stays around, we could get volatile trading, we'll get puts and takes. But I think as things start to shake out, we start to see real economic impact. That's when you'll start to see, perhaps the credit provisions, things like that. Banking fees is the one area where you are seeing some impact now in terms of, with all this volatility, people holding off, right? If CEO, you want to sell your business, you're not going to do it right now.
M&A, IPO on hold right now. So, Alison, how does this set us up for the start of regional banks reporting, which don't have as much benefit, if at all, from equity trading desks benefiting from all that volatility?
So I think the positive thing is that net interest income guidance was generally stable. And as I said, the provisions for many were already conservative, but we didn't really see that impact. And so could we see the similar at the regionals? So we could see similar. We could see banks being conservative, right? So again, did they decide to put in some kind of factor for the first couple weeks of April and that volatility, or did they mark to market at March 31?
Just real quickly, though, I mean, I just want to kind of circle back to the big banks for a second. When Jane Fraser talked about the idea how she wasn't too worried about global trade war and tariffs, and I know these banks overall, the big banks at least, are kind of insulated from direct tariff shock, but there is sort of a feed-through, a second-order feed-through. Right. How are you modeling that?
And I think what, like Jane's point is, and Jamie would say this too, is like, look, we're managers of risk. And so I think that's what you have to, you have to trust that they know what they're doing. And I think what they'll do is point to the protection. So Jane is saying we've had clients for decades, for centuries, right?
But managing risk in the past for some of these big banks has been a retrenchment, meaning they just don't, which doesn't necessarily help their bottom line and certainly doesn't help the economy.
I do think that's true.
Yeah.
The one thing I would point out is that if we think about some of the other periods of market volatility, so if we look at the pandemic, I mean, think about the uncertainty then. Right now we're dealing with some political uncertainty, but I don't think that's even a comparison to what we saw at that point in time. If we look at the global financial crisis, we had real issues at the financial institutions. In that crisis, we have healthy banks today. And so I think while there is a lot of uncertainty, they are much better prepared. And you're actually seeing it, right? The stocks are down, but certainly not if you looked at something like the CDS, what we saw in previous times of uncertainty.
Absolutely. Alison, great stuff. Alison Williams, senior analyst over at Bloomberg Intelligence. A closer look at the banks. And when we come back, a closer look at the auto sector and a big downgrade in that space. This is Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Coty. Bank of America double downgrading the cosmetics company to underperform from buy, halving its price target to $4.50. The move comes amid concern about weaker consumer spending and slowing growth in the current economic environment. Those shares taking a big leg down for a second day, down 8%. Next up, Workday, Mizuho, trimming its price target to $275 from $320, but maintaining an outperform on the stock. It's part of a broader note on the software sector that the analyst says may be at risk of multiple compression, and notes that names like Workday, Zoom, and Oracle show greater resilience amid the tariff and economic uncertainty. Those shares getting a modest boost on the day, 0.3% on the day. And finally, let's take a look at General Motors, moving lower here on the day after Barclays hitting the brakes on the car maker, downgrading to equal weight, chopping the price target to 40 from 70. The analysts saying that the Trump auto tariffs will put pressure on GM, noting that almost half of that company's cars sold here in the U.S. are assembled outside of the U.S. And those are some of our top calls. We're pleased to say that the analyst behind that last call joins us right now. Dan Levy is director and senior equity research analyst over at Barclays. You have the downgrade on GM. You downgraded some other names in the auto parts space as well, like Visteon and Aptiv and a few others. Let's start with GM though, Dan. What gives you what's your thought process behind thinking that GM is going to suffer the worst among the big manufacturers?
Yeah, Romaine and Scarlett, thank you so much for having me. I think the downgrade is really rooted in the view that there is a very difficult situation ahead for GM and others. For GM specifically, as you point out, just under half of the cars they sell in the U.S. are assembled outside of the U.S. And so there is significant tariff risk. We're haircutting our numbers by roughly 40% given the tariffs, the weaker volume, and that's giving them some credit on recovery from passing through to consumers and cost outs. But overall, a difficult earnings situation for them.
When we talk about what the earnings situation looks like, Dan, you modeled out some of the, worst case scenarios, if you will. What exactly are you looking for in that scenario? Like how much can we see earnings potentially eroded?
Yeah, in the downside scenario that we lay out, on average between Ford and GM, it's roughly a 70% cut to our current estimates. And really what's going on there is it's a few things. There is clearly going to be some volume erosion from vehicles that they can't sell anymore because it's going to be uneconomical, and also from consumer weakness on sales. There's going to be the tariff hit, which we estimate is roughly $4,000 per vehicle. And we're assuming, okay, maybe only 40% of that tariff hit gets passed through to consumers. And then there's a question on cost. So they're dealing with a few different variables. And I think either way you cut it, it's a challenging situation for them.
It's a challenging situation for them to sell to the U.S. consumer. What about selling to consumers in overseas markets? Because there's the threat always of retaliatory tariffs, even as some countries have rescinded those. And you've got much cheaper manufacturers selling EVs, for instance, BYD out of China, kind of threatening to gain market share, steal market share from some of these names.
Well, the good thing for GM, at least in that regard, is GM is by and large North American focused automaker at this point. There are operations in China, some parts of Asia, South America, but for the most part, substantially all of GM's earnings are generated by North America. So it's slightly less of a concern for them.
Now, having said that, you actually prefer Ford over GM, given a higher mix of U.S. assembled vehicles, yet you also have Ford relying more on overseas markets than GM does. Walk us through your thinking on Ford.
Yeah, and I would say it's more of a modest preference because Ford also is going to have some pressures related to the tariffs. Ford is going to have, similarly, roughly $3,500 per vehicle tariff impact. They'll lose some volume. And I think the challenge for Ford also is they're coming from a weaker financial situation. But the opportunity for Ford really is to take some share amongst the mass market automakers. Tesla side, they have the highest concentration of U.S. sales that are assembled in the U.S. So there's an opportunity for them to take some share, and that's the slight preference for Ford.
I'm curious, Dan, as to why you think the auto parts makers will somehow fare a little bit better than the actual car companies themselves.
Well, the auto parts makers benefit in two ways. First of all, they're more geographically diverse. So really, the call on tariffs is a North America-focused call. So that's number one. The other regions hold in a bit better. The second piece is right now, it's the automakers generally who are going to absorb more directly the tariff impacts. Now, we think that that pain gets shared throughout the value chain, right? Dealers, suppliers, consumers absorbing some of that. But we think that for now, as long as there is a parts carve-out, and we got a hint from President Trump yesterday that there could be a parts carve-out on USMCA, the suppliers are going to be a little less impacted by it relative to the automakers.
All right, Dan Levy, Director and Senior Equity Research Analyst over at Barclays. Thank you so much for joining us. And that's the equity perspective. You also have S&P threatening to perhaps downgrade the credit ratings of car makers like GM and Ford, as well as the auto parts companies because of the tariffs.
Well, this is kind of what I feel like could be the next shoe to drop. And we know that a lot of these ratings companies are always late to the party. But at the end of the day, when you start to talk about a deterioration in economic conditions and a deterioration in corporate bottom lines, at some point, the ratings companies have to take notice and actually adjust. Of course, they'll be a few months behind the curve.
They'll be a few months behind, and we're still talking about investment grade ratings for Ford and GM. But nevertheless, an actual downgrade does give room to see their borrowing costs increase.
And it poses a question too that there are a lot of companies, not necessarily Ford and GM, that have to refinance at some point this year.
Yes.
What are they going to be paying relative to what they paid the last time?
Well, what's going to happen next week? None of us know at this point. All right, coming up, we're going to take a look at commodities markets amid the global trade war with Natasha Kaneva, head of global commodities strategy at JPMorgan. From New York, this is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Scarlett Fu, and we're seeing fairly muted moves across asset classes today. Things have really calmed down since last week.
Yeah, and we talked about this yesterday. Kind of effectively a holiday week for a lot of folks. Of course, you have schools on spring break. You had the Passover holidays start over the weekend. And of course, this weekend up ahead, for the other folks out there, you have Good Friday and Easter. So probably not a lot of people at their desk. And I wonder if that's kind of skewing the price movements that we're seeing.
Absolutely. Volatility has come way down. Also, the price action is just much more muted. You look at oil prices, for instance, they've pretty much been flatlining the last 2 days. But unlike equity prices, which did recover a big chunk of their post-April 2nd declines, oil has really just kind of bumped along with WTI stuck at this $61, $62 level.
And I guess my question is, what is the message that that's sending? Is there something we can read into that?
Global growth concerns, definitely a big part of it, but also this idea of oversupply, especially with OPEC Plus's surprise move last week. So let's get a little more context on all of this and bring in Natasha Kaneva, head of global commodity strategy at JPMorgan. So Natasha, Talk to us a little bit about IEA's and forecast here to really cut down its demand forecast for this year by almost 1/3 and looking for that oversupply to last not just for this year, but into 2026. This is a long-term oversupply problem, isn't it?
Yes. Well, thank you for having me. This has been actually our baseline view. Our baseline view was for the last, since pretty much 2023, there would be a massive oversupply in both 2025 and 2026. So clearly, that's working out at the moment. So there was a lot of concerns about the demand, about recession and what exactly that means for the oil demand numbers. But in my view, actually, I'm putting the bigger weight on the supply side. I think there is a change in the reaction function of OPEC in that they decided to increase supply in an environment of declining oil prices.
Why?
So that's very concerning. So I think the market is playing, the market is trying to figure out whether OPEC is dusting their playbook from 2014 of 2020. One argument, and a very numerical argument we have been making, is that in general, if you look over the last, for example, 2023, a 1 million barrel per day cut in the OPEC supply was actually resulting in a $10 increase in the price of oil. Last year, that was $8. This year, it's $4. So the argument we were making is that cutting supply, and when the price is $80, makes sense.
Yeah.
Cutting supply, and when you're getting only $4 out of that, and you're looking at a $60 oil price forecast, that makes zero sense. So actually what makes more sense is to increase supply to maximize your revenue, and that's what I believe that's exactly what is happening at the moment. So if you look where we're trading at the moment, $60, that was actually our end 2025 price target. We reached it about $8 earlier, 8 months earlier. What the price is pricing in at the moment, it's about 80% probability of a mild recession and 1 million barrels per day of additional OPEC supply.
Okay, so it does feel like OPEC Plus is kind of a wild card now in a way that it wasn't before. I want to go to the Bank of America survey of global fund managers because a net 61% of respondents expected the U.S. dollar to depreciate over the next year. And I'm wondering how you think about the relationship between oil and the dollar. To what extent does a weaker U.S. dollar drive oil and other commodities prices lower, or is a weaker dollar simply a reflection of the weak demand dynamics?
Opposite. The higher the dollar goes, the...
Pardon me, yes.
So definitely the weaker dollar would provide support to the prices by all means. But at the moment, we believe that actually the impact is less of a dollar, but it's more of a supply and the concerns of how to think about that. Another way to think is that what is the floor to the price? If previously we were assuming it's $70 because you had OPEC stepping in, you had the Biden administration refilling. Yes, that was the guidance from the Biden administration, that when the WTI drops to $69, they will be refilling the SPR. So there was a very strong floor price. At the moment, we don't have OPEC, and we have the Trump administration very actively, very openly pursuing substantially lower oil prices. So our view is that there will be no intervention from the Trump administration unless WTI hits $50.
$50. But that's still a long way to go. Well, actually, not that long away. But if we get to that, I mean, wouldn't that be a symptom, though, of other issues going on in the economy? And wouldn't it potentially blunt whatever upside effect they would have?
Not necessarily, because we have not changed our 2026 price forecast. And that was $60 Brent, $55 TI. By definition, you will be looking at a $5 handle. Substantially lower prices. But, the argument we made is that if the Trump administration does absolutely nothing about oil, they will get the $50 price just because there's so much supply.
I am curious about what we've also seen in other parts of the commodity space, particularly in industrial metals. I feel like it was a year ago we were looking at copper at 11,000. Even just, 3 weeks ago it was over 10,000.
Yes.
I think we're at 9,100 or something right now. Is there a sense here that we're going to end up in a tight trading range on copper futures, or is there a potential for a breakout either to the upside or downside?
We believe actually that copper is trading too high at the moment. So our price target is too high, 8,300 for the second quarter. The main reason for that is our economists looking at a 60% probability of recession. We have North America in a recession. So for that matter, $90, $91, $9,200 copper price is way too high. So that needs to come lower. But we do expect that by the third quarter, China will step in and start stimulating.
But even with the potential impact of tariffs and other trade restrictions, you think prices will still be depressed?
Correct. If you have PMIs below 50, base metals cannot perform in a PMI recession. That's out of question.
The demand story is just not there, in other words. Trump, of course, in February issued an executive order looking into investigating whether copper tariffs need to be imposed. How are you seeing this get resolved, and over what time period? Is it going to be a driver for prices?
So the argument we have been making is that, so there's 34 critical minerals. Copper is not one of them. Aluminum, interestingly, is, but copper is not. And so we believe that actually it makes sense to add copper to the critical mineral list. And because of that, all the restrictions that comes with that, or all the incentives that come with that have to be in place. So for example, development of mines. Yes, we have the copper belt going through the United States, like Arizona and all other places. So that needs to be developed, and you need to expedite the permitting and all other things that is happening in oil and gas, but it's not happening on the copper side. But overall, you're absolutely correct with your questions, is there's massive concern in the market about tariffs and the impact on demand, copper included.
So a lot of the major copper players in the industry want President Trump to restrict exports of ore and scrap metal rather than imposing tariffs on imports. Do you see this argument making sense for the administration?
So I think restricting, it's a big word. What I personally would suggest is adding it to the critical minerals list and expedite production. So pretty much increase supply rather than trying to keep this domestically.
Before we go, I have to get your thoughts on precious metals. Of course, we saw that big run up in gold. I think it's still up again today as well. Is there any sort of ceiling to this, to how far this can go?
So months ago, we wrote about the $4,000 gold price. I had in mind 2027. Yeah. So it does appear that actually we're getting much faster to our targets. A couple arguments. The time is compressing, so it took 38 years to get from 1971 to get actually to break the first 1,000. That was March 2008, the global financial crisis. Then it took 12 years to get to 2,000. That was COVID. Not COVID, the global financial crisis, I'm sorry. And then it took less than 5 years to break the 3,000, and that was COVID. So everything is compressing. It takes 2/3 less time to get to the next level. So if you do this math, the 4,000 should be 2027, but it does appear that we're getting there much faster.
Absolutely astonishing. It's particularly for such a hard asset like that. Natasha, always wonderful insights. Natasha Kaneva, head of global commodity strategy over at JPMorgan. A look at what's going on in commodities. When we come back, we move back to the public equity markets and take a look at shares of Albertson having their worst day since 2022. This after the grocer issued a weak profit outlook. That's coming up next in our Stock of the Hour. This is The Close on Bloomberg. Time now for our Stock of the Hour. Closer look at shares of Albertsons, the grocery chain, moving lower by about 8%, worst day since 2022. The company beat in its most recent fourth quarter results, but it did give guidance that missed estimates, particularly on the bottom line. The grocer's annual outlook also excluded the impact of tariffs, saying they domestically source most of their products and that they are monitoring tariffs closely. Monitoring the situation for us here at Bloomberg is Bailey Lipschultz, who helps to lead our stock coverage here at Bloomberg. All right, talk to me a little bit first about the forecast, because that seemed to be a big part of the reason why we saw the drop in the shares today.
Well, we've been seeing companies either throwing in the towel with guidance and kind of fully punting or talking down expectations. Albertsons elected to do the latter, but the big thing when you look at this, talking about some of the pressures they're seeing from bigger competitors. When I talk to bankers and investors in the consumer space, they point at the collapse of this deal with Kroger and say, hey, Walmart is where people are going. Yeah. Costco is where people are going. Walmart also owns Sam's Club. Like, people are trying to find better ways to purchase goods and groceries. And obviously, when you look at the Albertsons earnings, that showed up.
And is it the idea that Albertsons just doesn't have the scale to compete on price the way that Walmart or
well, that would be the argument that Kroger made, definitely, although that didn't get very far. So I guess the question is, what does Albertson do to find new sources of revenue growth?
Well, they're kind of leaning into, in my view at least, kind of the Target model, almost trying to push some private brands. And that's kind of a way to try to expand margin, maybe grow sales more organically. But we are in such an era where people are going to kind of downgrade their spending. So they're maybe not paying up for Campbell's or more expensive goods. But again, it is interesting to see them so kind of vocally call out the impact of some of these bigger clubs.
Even when people go to in-store brands, they choose which store they go to for those in-store brands, right? Like, I would prefer going to Costco for Kirkland rather than, Albertsons, whatever its generic brand is.
Yeah, I mean, I'm a big Costco fan. And I think that the Kirkland brand has its own loyalty. Are you a Walmart guy?
I'm neither. I've been in a Walmart twice, and once was to use the bathroom. So when I was on a road trip, and someone dragged me into Costco once, and never, ever again. But in all seriousness, though, it gets to this idea that, when you think about economic downturns or economic softness, whatever you will, you would think grocery stores in general will hold up, because at the end of the day, we all have to eat. And I understand cost shift, that okay, maybe you don't buy the high-end steak, maybe you go for a lesser cut, or you buy chicken or something instead. I don't understand why they can't make that adjustment on the fly by changing up their product mix.
Well, I think it's more difficult than that, but I will also call out the stock is still up 1.4% on the year. S&P is down more than 8%, so you are outperforming on a relative basis year to date. The one thing that the management team did call out that also stood out to me was kind of just this notion that they're going to lean into some of the digital products, so trying to get customer loyalty and people using the apps and rewards points for a reason to come back in. But when you kind of have to pull that lever, not really a good sign. The one thing that also stood out, in an uncertain environment, they're calling 2025 an investment year for 2026. Not great.
Not great. Digital sales rose 24%, but everything else was like a 2% increase.
I don't want to add to it. There's no country for old men here, Charlotte. I mean, some of us just want to go in and just, buy things and leave. I don't want a relationship with you.
You don't want to share any kind of information whatsoever.
I don't want an
with
experience. I want to transact.
Romaine Bostic, I don't want an experience.
I give you money, you give me something in return. That's it.
Very transactional, Romaine Bostic in the grocery store.
You like this tie, Bailey?
Yeah.
Yeah, I found it in the back of the closet today, and I was like, I hadn't worn this in a while.
Nice. Busting it out on a...
That's what consumers are doing around the country. Going shopping in their own closets, shopping in their pantry.
That's right. It's real. The struggle's real, Scarlett.
Bailey Lipschultz, thank you so much. Where do you buy your groceries? At an Albertsons?
ShopRite. I'm a ShopRite loyalist.
See? He's using his little digital
I do
card.
use digital coupons, man. You can save some money. Do you Instacart? Are you an Instacart person?
No, I refuse to pay the delivery fees.
Yeah, same.
I'm against that. It's what happens when you're Gen X. All right, coming up, we're going to take you to the closing bell with Emily Roland. She is Chief Investment Strategist at Manulife John Hancock Investments. We'll have more to come. This is The Close on Bloomberg.
You've got a lot of stocks that we really like the fundamental stories of, but when you look across the market from an allocation of capital perspective, we have a lot better opportunities that are now available to us. Now we have to manage the risk of that appropriately. Do we understand the downside of the fundamentals that could be coming out? Is it still a good value in our opinion?
Aaron Dunn, who helps run the value equity program over at Morgan Stanley Investment Management, kicking us off to the close 50 minutes ago. And Scarlett, this is one of those days, and quite frankly, the last few days, that if you are a bottom-up stock picker, I guess this is your time to shine, but you also have to have a bit of bravery and conviction in whatever call you're making.
He's talked about understanding the downside. I think if people do understand the downside, it's quantifying the downside that tends to be somewhat difficult. You have the S&P 500 not doing a whole lot of anything, although it's notable that it's in a death cross pattern with the short-term trading average, the 50-day moving average, falling below the 200-day moving average for those who want to go by technicals. Yeah,
we closed at that death cross, if you will, yesterday, and a lot of people pointed out, and I think it was like the first time since 2022 or whatever, but a lot of people pointed out that, okay, look, historically, that typically is a sign that that correction we were in could re-intensify and turn into an actual real bear market. But we'll see. We talk about the market moves today, and we should point out once again here, volume is incredibly light here, as a lot of people are away from the desk. But Scarlett and I are here, and so too is our next guest, Emily Roland, never taking a day off, Co-Chief Investment Strategist at Manulife John Hancock, counting us down to the closing bell. Great to see you, Emily.
Great to be here.
I know these last few weeks have probably been stressful, to say the least, for you. But I want you to know if you can kind of make some sense of the chaos here. At the end of the day, we talk about an investor class that wants to be invested, in many cases has a mandate to remain invested in this market. Where do you go?
So I think one of the most notable things about the cross-asset dynamics is they don't really mesh with the macro backdrop. Remember that Sesame Street song, one of these things is not like the other? And when I think about tariffs, the fact that the leadership's been in Europe, European banks, German cyclicals, and things like Chinese tech stocks at one point, it just didn't seem to mesh with the sort of slowdown in global growth that we probably get if tariffs are implemented, and it's starting to show up in some of the data. Meanwhile, high quality U.S. stocks have been sold off the most. Now, admittedly, there was a valuation issue there coming into the year with the U.S. large cap growth index trading at almost a 50% premium to its 20-year average. So there was more room for some of those stocks to come down, but it's almost like throwing the baby out with the bathwater. These are high quality companies, a lot of whom have great balance sheets, lots of cash, and potentially a better ability to ride some of this out.
And I think we did see some of that. Some people kind of acknowledging that with the rally that we had the last couple of days, and Apple and a few other tech names, and Netflix doing great today as well. But it gets to this idea. We've talked so much about the decline of American exceptionalism, but kind of lost in that too is that if we are headed for a global economic downturn, which country or which financial market would you be most willing to make a bet on? Now, historically, that's always been the U.S. Why would it be different? Is there a reason why it would be different this time?
Yeah, I mean, remember the old adage of when the U.S. sneezes, the rest of the world catches a cold, and that's still true. This is a global economy, and if U.S. exceptionalism is at risk, global exceptionalism and global stocks here are at risk. So we actually think more defensive, higher quality markets with better, more robust earnings growth potential. I'm not saying we're great in the U.S. We've got a lot of problems here, of course, in terms of growth. But I do think that, again, looking to that quality factor makes a lot of sense. And Europe is just more cyclical by nature, given the fact that there's a lot more in value, energy, industrials, you name it.
So here's the thing that I don't quite understand. You have surveys like the Bank of America Global Fund Manager Survey showing 82% of respondents expecting a global economy to weaken. That's at a 30-year high. And then you listen to the bank executives on their earnings calls, and they sound okay. They're not particularly worried. I mean, they're provisioning for bad loans, but not in a way that screams panic. How do we reconcile that?
Well, it's unbelievable because the economy and the earnings backdrop are actually just fine. In fact, if you look at the hard data in the United States, we like things like initial claims, which are really timely. We're still in the low 200,000s. You look at high yield bond spreads, which did spike, but we're actually back down to about 410 basis points over Treasury. So the data are telling us that everything's decent. But people are saying that it's horrible. I mean, you've seen it in the Conference Board's Consumer Expectation Index is at a 10-year low. University of Michigan Sentiment Index rolled over. And we're now finally, I don't want to say finally because it's not great, starting to see it in Europe as well with things like the ZOO survey and the Centix Index starting to roll over. There might be an element here, though, where businesses and consumers are saying one thing and doing another. And I think that really speaks to the divergence between the hard data and the soft data right now.
So if something broke last week from all the turmoil and all the question marks over what's going to happen, what was it that actually broke?
Well, you saw this massive divergence between Treasury yields backing up and the dollar declining. That is really unusual. In fact, we drew a chart that just showed how highly correlated the two have been over time. And really, we saw the biggest gap we've seen in some time opening up there. What was especially odd about the 10-year Treasury yield backing up, or really yields across the curve, was that it came in the midst of weaker inflation dating or softer inflation data. So CPI mix, shelter, finally came in at only 0.2% month over month. The PPI data missed. The City Economic Surprise Index actually moved lower last week. And meanwhile, 10-year Treasury yield saw this massive backup. Now, there's tons of narratives around what it could be. Is it foreign owners that are selling treasuries? Is it a just sell everything American, whether it's dollars, treasuries, stocks?
For a while, it looked like it.
Yeah, it did. And there's also, some talk. All these things are hard to quantify. Is it some institutional player that we don't know about? But I think what you saw restore some calm to markets. Susan Collins, of course, came out on Friday and said, the Fed probably will step in if there's some more sort of dysfunction in the Treasury market. So I think that provided a bit of solace to investors. But it's a notable dynamic that we think ultimately 10-year Treasury yields will start to move with the economic data, but we're not there yet.
What do you think actually, though, happened last week? Because, we've had Scott Bessent on this network, including yesterday and last week. We've had the Deputy Treasury Secretary, other members of this administration. In their view, this was not about foreign selling. This was not about financial plumbing that was in danger of breaking. Was that your view?
Well, we were all like Googling the basis trade, right? A couple of weeks.
Right.
I'm just kidding. I knew what it was. No. But I think there's a lot of explanations out there for it. And you guys did some great reporting with Basent. And I think, we looked at holders of U.S. Treasuries, and China's actually a smaller holder of Treasuries than many people think. It's actually about 2%. Japan's bigger. And then when we looked at some data that suggested last week that China was actually a net buyer of Treasuries. So I think, I'm not saying you can totally throw that story out, but it's still hard to quantify what's going on here. What we see is that U.S. high quality bonds are on sale.
Yeah, absolutely. Emily, great stuff as always. Emily Roland, one of the best in the business, co-chief investment strategist at Manulife John Hancock, as we count you down to those closing bells. We're just about 2 minutes away from those, Scarlett, and a market here decidedly unchanged on the day.
Yeah, very calm, very quiet. Volume has really dropped off over the last couple of days.
As we move closer to those closing bells, stick around. A full breakdown of all of today's market action with our global simulcast. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through that closing bell. A global simulcast. It starts right now. Carol Masser, Tim Stenovic, they're in the radio booth. They join us as they do every day at this time as we welcome our audiences across all of our Bloomberg platforms. Another low volume day, Carol Masser here, about 27% below where we would normally be in terms of volume. And the net effect of it all is an S&P that's relatively unchanged.
Yeah, it feels kind of anemic, right, in terms of the trade. Really, really kind of mellow. But we are off our best levels of the session. However, take a look at the big banks. Thank you, Bank of America and Citi, because you've got the KBW Bank Index up about 1.2%. So some outperformance certainly in that group.
Not a lot of conviction in today's trade, at least according to the S&P 500. We did see it move between gains and losses just a little fewer than a dozen times today, but really hovering at that unchanged portion for some of the day around 1 o'clock.
It definitely feels like everyone's waiting for another shoe to drop, but they need to wait a few more weeks before it does, certainly until the end of this week, because there's not a whole lot going on, right? You have Jay Powell speaking, and so maybe people are holding off until then.
Good point.
And you also have a holiday shortened week and, waiting for more people to come in, waiting for more earnings to come in for companies to say that they have no visibility.
I do wonder if the shoe that is going to drop, Scarlett, is it domestically produced or would that shoe be imported?
And we talk about earnings too. We are going to get some earnings after the bell, including out of United Airlines, J.B. Hunt, the big trucking company, as well as Omnicom, of course, a big advertising agency. So we'll get a little bit of a cross section here of economic conditions. Just want to point out too, headline crossing the Bloomberg terminal, a huge drop today in the Swiss franc. Remember, that had been a huge part of a lot of that disruptive trade that we saw last week when it came to the dollar, as well as treasuries here, a 1% drop on the Swiss franc relative to the dollar on the day. Meanwhile, the majority of the S&P stocks are in the red, but the net effect of it relatively unchanged. A loss of about 9 points or 0.2% on the benchmark index. The Dow Jones Industrial Average down 156 points or 0.4%. The NASDAQ unchanged on the day. And Scarlett, the Russell 2000 coming in on the day here with a drop of roughly about I take that back. A gain of about 0.1%.
Okay, so pretty muted moves there for the major indexes. Let's get you some earnings that just crossed. United Airlines reporting first quarter adjusted EPS of 91 cents, beating the consensus estimate of 74 cents. United also sees its second quarter adjusted EPS of $3.25 to $4.25. So that's a $1 band. Analysts were looking for somewhere in the neighborhood of $3.97. So it's a little bit all over the place when it comes to second quarter adjusted EPS. For the full year, it has maintained its forecast. It still sees anywhere from $11.50 to $13.50 if bookings are stable. And of course, that's a big if because we don't know what the situation is when it comes to tariffs and uncertainty. And as a result, United provides two full-year adjusted EPS scenarios amid all this uncertainty.
Can I just say United provides two fiscal year adjusted EPS scenarios and uncertainty? I can't even remember the last time I've really seen a company do that, but I know.
Yeah, I mean, it's at least they provided something though here, so maybe that gives investors something to hang their hats on.
Amazing.
Meanwhile, Interactive Brokers reporting results as they crosses the wire right now. The company's first quarter adjusted net revenue coming in line with estimates at about $1.4 billion. Net interest income a slight miss at $770 million. The street was looking for roughly $794 million. The company also saying that its total customer accounts did tick up just ever so slightly 3.62 million. Street was looking for 3.61. We're going to dive a little bit deeper and see if there's any forecast. Not jumping out at the moment. Shares unchanged in the after-hour session.
Okay, let's go back to United Airlines. Shares higher by about 2.4% in the after hours. As Carol mentioned, the company did provide 2 fiscal year adjusted EPS scenarios amid uncertainty. The company sees second quarter adjusted EPS $3.25 to $4.25. The estimate was for $3.97. United still sees fiscal year adjusted EPS $11.50 to $13.50 if bookings remain stable. Sees fiscal year adjusted EPS in recessionary scenario $7 to $9. So a big cut if there were a recession. Again, United coming out with 2 different fiscal year adjusted EPS scenarios amid uncertainty.
All right, guys.
But just to that point, though, too, because I'm trying to remember the last time I saw a major company give that type of range. I mean, this is kind of what analysts do on Wall Street. They kind of give the bull case and the bear case. But it gets to this idea. We've had a few CEOs on this program and CFOs talking about this idea. They were reticent to give guidance primarily because, A, they didn't want to get sued, but also just this idea of how do you even know?
So what do? You hedge your bets and say, listen, if this happens, here's what could happen for us. And if this happens, here's what else could happen. I mean, I can't remember last time I've ever kind of seen that from a company. So pretty interesting.
It feels like investors like it, though, given that the stock is higher in after hours trading. And it's a little more honest than to say we have no visibility. We don't know. We're going to keep our guidance, but it'll exclude the impact of tariffs. They're saying, here's how we're thinking through everything.
And I will say that they are pulling in their fiscal year adjusted CapEx below $6.5 billion. They had seen up to $7 billion. The street estimate was $6.7 billion. So this again speaks to maybe pulling in a little bit in terms of their spending.
I briefly want to jump in with Omnicom, the advertising, marketing, communications company. Shares in the after hours are unchanged. The company did report first quarter revenue that came in pretty much in line with estimates at $3.69 billion. First quarter adjusted earnings per share coming in above estimates at $1.70.
And I'm kind of curious, too. I mean, obviously, Omnicom itself, of course, isn't necessarily a barn burner of a stock, but don't forget we get Netflix in a couple of days, and it'll be interesting. And of course, with that new ad tier, it'll be interesting to see how they fare during the time, and particularly going forward with, if they do offer guidance going forward, sort of what that ad tier actually looks like, particularly if you do think that we are headed towards some sort of economic softness.
I wonder if United, by giving 2 scenarios, gives permission for everyone else to therefore give different scenarios in their earnings outlook as well. You open the floodgates and now everyone can say, okay, here's what it looks like if things go on as normal. Here's what it looks like if we dip into recession.
Because it was big news last week when Delta essentially pulled its guidance and said there was too much uncertainty. We can't tell you what we think we're going to do because we have no idea. Do then other companies come back and say, okay, wait a second, we can provide these 2 different scenarios. Here's what we're thinking if there's a recession or if there's a slowdown. And here's what we're thinking if things go undisturbed.
I agree with you, though, Scarlett. Investors giving them props. I mean, you got United Airlines up about 4.8% here in the after hours. So maybe investors saying thanks for giving us and laying it out for us. American Airlines, folks, I just want to point out, also up about 1.6%. Delta's up about 2.4%. JetBlue up about 0.8%. So we're seeing the whole group being lifted. I know you've got some earnings there, Romain.
Yeah, J.B. Hunt, the trucking company, out with its first quarter EPS numbers, $1.17. That's what's coming in. That beats street estimates. On average, they were looking for $1.15. Revenue, $2.92 billion, a slight beat as well over the average of analyst estimates. And the company saying that its dedicated revenue at $822 million. That's actually a little bit of a slight miss. Nevertheless, the shares up by about 1.4% here in the after hours trade. And the big question I have going into that conference call isn't so much about guidance, but this idea here as whether this company is in the moment a beneficiary here of some of that pull forward that we seem to be talking about anecdotally with regards to consumers trying to get their hands on everything they can before the tariffs kick in.
And how long does that pull forward last? We saw that certainly at the end of the first quarter, and we're definitely seeing it at the start of the second quarter. But now that you have this 90-day reprieve on most of the tariffs, does that continue until we get a final word on the tariffs?
Hey, I'm just going through United's statement to try to get more color and clarity on these 2 different outlooks. The company did say this is a challenging macroeconomic environment. They also said they're removing 4 percentage points of scheduled domestic capacity in response to the current demand environment. They're going to do that starting in the third quarter of 2025. They're also saying they're going to make prudent adjustments to the utilization rate of its fleets, including ongoing reductions of off-peak flying on lower demand days. They expect to continue this approach into the fourth quarter of 2025, and they're going to retire 21 aircraft earlier than previously planned. That part they had announced previously.
Listen, we said that these earnings were all going to be important. We're just getting going. But I mean, they're laying it out. They're kind of to saying that, yeah, there's uncertainty, but here's how it could go if we see kind of a change, maybe when it comes to tariffs and the economic environment. Good news versus maybe not so good news. I mean, I'm looking at United, mind you, they've been hammered this year, like a lot of the airlines. It's still up about 4.5%. I feel like the earnings analyst call is going to be really crucial because I feel like analysts are going to push them, even further. Like, which scenario is more likely, the bad one or the better one?
Yeah, but then that sort of requires them to be kind of like, economic, strategists, macro strategists, if you will. I'm sure it's something that they'd rather avoid doing. But it gets to this idea, too, as to who is now making that call, right? Because this really goes beyond the purview of what the normal job duties would be of your CFO and certainly of the CEO, him or herself. So the question is, who do they have on staff there who is kind of the economic whisperer, if you will?
Yeah, it's a good point. Also a good point is the idea that they're giving two scenarios, but there could be any number of scenarios. So it could be countless scenarios, but at least by giving two extreme scenarios, it kind of resets expectations in terms of it could be anywhere from here to here, and we'll just see how it goes. Worth noting as well that Delta and American Airlines shares are following United higher in after-hours trade.
I was just on a United plane.
Yeah?
Yeah.
How'd that go?
How was the meal?
I made it back.
How was the meal? Shake Shack burger?
No, there were no Shake Shack.
Oh, you were in the back of the plane, right?
Yeah, sure.
Yes. Did you get peanuts and a pillow at least? Only kidding.
Twisting that knife a little bit there.
I see how he flies. He's in the front of the plane. All right, that's a wrap. Our cross-platform coverage. Earnings just getting started, folks. But we're going to wrap it up on this Tuesday on radio, TV, YouTube, Bloomberg Originals. Be sure to catch us same time, same place tomorrow.
A lot more coming up on the big program. You saw those earnings out of United, raising a lot of questions, not just about the health of the company, but quite frankly, what is the health of travel going forward? We're going to further break down the results out of United and get some broader perspective on international travel with James Ferrara, CEO and co-founder of Inteletravel. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. It was an interesting day on Wall Street. It looked like we were going to get an extension of that rally. Of course, a rally that showed a lot of strength over the last couple of sessions. But today we did open higher, but only modestly. The S&P got up to about, 0.8 or so of a percent of a gain on the day. But as you can see on the screen behind me, that did not hold. It faded into the close, and a modest drop on the day of about 0.1% here. And that was kind of indicative of what we saw with some of the other major indices. When you go down on a sector basis, it was a little bit of a tale of two cities there. You did see a lot of strength once again here in the financial space as we got more earnings out of the big banks, this time out of Citigroup as well of Bank of America. They're not really shook right now about tariffs, not really shook right now about the potential for a recession. But keep an eye on the airlines. They did rally here on the day. We just got United reporting just a little while ago. As we were just talking about, Scarlett, they gave a very wide range of potential outcomes of going forward here. But overall, they're saying right now they can navigate through any potential economic risk.
And of course, it depends on what happens, but they did give two different scenarios in case there was a recession. Let's take a look at some of the day's big movers. And I want to start with Netflix, one of the biggest advancers in the S&P 500, as well as the NASDAQ 100, after the Wall Street Journal reported that the streaming giant aims to double its revenue and reach $1 trillion in market capitalization by the year 2030. So ambitious through the turmoil and stating that ambition pretty clearly. And Boeing, a big decliner here, off by 2.4% on the day, increasingly on signs that aviation has become a political football. Bloomberg learning that China has ordered its airlines not to take further jet deliveries from Boeing as part of a larger effort to halt purchases of equipment and parts from U.S.-based companies. Romaine?
All right. Meanwhile, we keep an eye on what's been going on in the broader markets, particularly when it comes to volatility. The VIX, which measures stock market volatility, hovering around 30. Now, that's down significantly from last week's intraday high of 60. We should point out the MOVE index, which tracks volatility in the bond market, also lower, but of course, still elevated from where it was just a few weeks ago. Nancy Davis is the founder and portfolio manager over at Quadratic Capital Mgmt, and she says there is still a lot of uncertainty in markets. Volatility will remain elevated while markets try to determine the path forward. Pleased to say that Nancy is right here in studio, too. Great to see you in person, Nancy.
Great to see you.
All right. I don't think anyone expects volatility to go away anytime soon. But is it going to be onerous? Are we going to start to see like the types of spikes that we saw over the last week and a half? Is that going to become the norm for the foreseeable future?
So I think everybody's looking at the VIX. People are really focused on equity vol. And the thing I like to stand up and make people aware of is that your bond portfolio is what you should actually be worried about, because bonds have 27% of the Bloomberg Ag Index is mortgages. Mortgages are short options, right? Think about it. Homeowners are long the option to prepay, so mortgages are inherently short volatility. Now, it's not equity vol, it's interest rate vol. And so I think it's so important for investors to realize that even if they're doing nothing, just with a regular vanilla bond portfolio, they actually are only short volatility.
I am curious, though, but in that environment, and I understand your point about short vol with regards to mortgage debt, but with interest rates where they are, and with the Fed basically saying, at least publicly, that they're not planning to change them, or at least lower them anytime soon here, does that not offer some degree of protection from being short mortgage-backed securities?
You know, it's really tricky because mortgages obviously have that spread component as well, and mortgage spreads have been widening along with credit. I think the thing I just want to keep in mind is people look at, our ETF sometimes, which has a big name and it has volatility in the name, and they think, oh, it sounds scary. I'm like, no, it's treasuries plus long options. It's not that scary because you already have short options inside of your bond portfolio.
Gotcha.
So when you look at volatility measures, and it could be the VIX index, which has come down quite a bit, now at 30, did dip below that level yesterday and today, and the MOVE index, which certainly off its high, but not as much as the VIX. What does that tell you about how investors are positioned for volatility going forward?
I think the thing to keep in mind with both of those indices is they're just one market, right? The S&P is 30-day, which is what the VIX is, and then the MOVE index is 30-day swaptions. What we access inside of IVOL, the quadratic interest rate volatility and inflation hedge ETF, it's a different type of interest rate volatility, and it's trading around 4 basis points a day is the implied vol. So it's very different. There are a lot of different types of options markets, and it also depends on the tenor. So longer dated options and rates are actually cheaper volatility than short dated options. So if you're long volatility in interest rates, you can actually roll up the volatility curve even if nothing happens.
How do you think Jay Powell's comments tomorrow is going to change that structure?
I mean, he almost seemed gleeful on Friday, the last time we heard him talk right after Liberation, right? He seemed kind of like, not my problem, immigration, not my problem, tariffs, not my problem, fiscal policy, not my problem. So I'm really interested to see just if his tone is a little different. I think it's not really what he says, because he really always says the same thing, data dependent, wait and see. I don't expect that to change, but I think it'll be interesting if his tone is more sensitive to what's going on and the losses that people are having in their day-to-day lives, especially in the bond market.
Yeah.
With regards to the bond market too, though, I mean, in terms of the activity, I mean, we saw a lot of activity on the short end of the curve as a lot of people are trying to game out if the Fed does do something, and who knows what's going on in Jay Powell's head. I assume whatever he's telling us isn't actually what's in his head. But is there a sense here that when you talk about sort of guarding for interest rate risk, interest rate volatility, that part of the issue right now is we don't really know which direction the Fed might go if we are in a situation where they feel inflation's out of control and they need to adjust rates to that, or if it's an economic recession and they need to adjust rates to the downside to goose the economy? Is that the issue right now?
Yeah, I think it's so, we had such a head fake last year in the rates market because coming into, 2024, the market had priced in 6 cuts, remember? And those didn't all materialize. And
we
so
talk
now,
about it every day.
I know. It's like the topic du jour. But I think the term structure is what we need to be focused on right now. The yield curve, in treasuries is about 50 basis points if you pull up your Bloomberg terminal, but the swaps market is trading cheaper. So what we access in IVOL is actually the 2s, 10s SOFR swap curve. That's trading around half the price of the treasury curve right now, only around 25 basis points. Wow. So that's the spot curve right now. And that's pretty wild,
is
right?
Is that healthy, though? Because then I was also looking at the term premium on the 10-year, and I mean, that's blown out to the worst since 2014. So basically a decade here. And yet, Scott Bessent tells us that last week, nothing was really going to break behind the scenes. I'm not sure if I believe that.
Yeah, it's a little hard when people say nothing's going to happen, because I think the Fed only controls the overnight rate, the policy rate, but the term premium of interest rates is set by the rest of the world, right? It's where companies, sovereigns, the rest of the world wants to lend money, and we're really seeing a blowout between treasuries and swaps. I think that's a sign that there's a leverage and funding problem.
All right, and of course, we know that the Fed has made clear that if there does become a bigger problem there, at least according to Susan Collins, the Fed would be willing to step in. Nancy, thank you so much for joining us. Nancy Davis is founder and portfolio manager at Quadratic Capital Mgmt. Coming up, we have shares of United moving higher in after-hours trading, helping to lift American and Delta as well. We're going to speak next with James Ferrara, CEO and co-founder of Inteletravel. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Mark Carney, Canada's Prime Minister and Liberal Party candidate, riding anti-Trump sentiment. He is leading the election race there by 5 to 7 percentage points, despite being a fairly newcomer to politics overall.
And I'm keeping an eye on Ryan Cohen. Of course, you know him from his forays into GameStop. Now learning here that apparently he's taken out a margin loan. He's going to now ramp up his bet on GameStop here. He's increased his investment in the company by buying 500,000 shares. He's in total now roughly about 8.4% of the total shares outstanding, 37.3 mil.
Okay, didn't help GameStop shares today, though. Third on the docket is Joe Creed, the 28-year veteran of Caterpillar, was appointed as CEO of the machinery manufacturer. He will start on May 1st.
All right, meanwhile, we're keeping an eye on Scott Kirby. He's the CEO of United. That company just out with earnings a while ago here. And all the talk really is about the forecast range that they gave. A forecast range, of course, right now being a little bit fogged up here by economic conditions. We're going to have to wait till tomorrow morning for that conference call here. But pleased to say, joining us right now to talk about some of those travel trends is James Ferrara, CEO and co-founder of Inteletravel, a host travel agency with more than 60,000 independent home-based advisors. And James, I am curious. I've seen a few data points here. This seems to suggest we're starting to see a drop-off in inbound international travel to the U.S. I think the overall number was like 10%. And if you go by country-specific, I think with Canada, it's even worse than that, like 50 to 60% lower than what it would normally be in terms of forward bookings. Are you seeing something similar?
Absolutely. I mean, this is inbound international visitation, which is not something that a lot of American travelers are concerned with or think about, but it's a big part of the industry. And individual countries, Canada's the worst, but there are countries in Europe in the 20% and better drop off year over year. So if the effect of the current trade negotiations, tariff war, the really measurable effect is here in inbound travel to the United States. Mm-hmm. And it's boosted not just by the tariffs, but by the rhetoric, the anti-foreign rhetoric. Mm-hmm. There are a few things that are contributing.
I am curious. I'm just curious in terms of what people are booking for those that are still willing and able to travel. Are you seeing a significant change in where they're going or where they're not going, for that matter?
No, that's the thing. So we see this big effect on inbound international travel, but I can measure no effect at all on travel outbound or domestic travel in the United States. In fact, it's we had a very strong first quarter. We've had record years year after year since the pandemic. Mm-hmm. It looks like another record year for 25. Certainly there are things in the air, right? There's the fear of inflation, recession, even there's some job loss. There's there are things swirling around, but there's nothing in the numbers yet, Romaine, and it may show up, mm-hmm. but it depends on how long this goes on, how long this trade negotiation goes on.
It'll be interesting to see if the dollar does lose some of its strength, whether that affects demand for international travel from Americans to go abroad. I'm curious in terms of what the outlook for business travel is, and in particular, people attaching their personal travel to business trips, because that's something we've started to see pick up after the pandemic. And I wonder if that's going to drop off as the economy, or if the economy should weaken materially.
I don't project that. bleisure travel, we call it, or blended travel, a huge trend the last couple of years. It is one of the things that has helped push the business travel market back. So corporate and business travel came roaring back the last year or so, and that momentum is carrying into 25. I think very hard to stop.
Very hard to stop. Okay. In terms of the different forms of travel, what kind is most resilient to the uncertainty sparked by all the turmoil? We talk a lot to cruise ship operators and how, people are booking, months, if not a year in advance.
Yeah. Well, look, cruise and all-inclusive resorts, they're such a strong value and such high satisfaction rates with customers and repeat rates with customers that the bookings for this year, we're having capacity issues already. We're having customers come back and say they can't get the dates they want or can't get the accommodations they want. So again, I don't see that changing. My belief is that vacations are still the priority for Americans. I think the area that's really going to get a boost out of this whole scenario is domestic travel, right? So people are a little concerned about crossing borders right now, about perhaps retaliatory border control policies from other countries. So I think domestic travel is going to get a big push.
All right, James, we have to leave it there. We have to get you back on here for a longer conversation. James Ferrara, CEO and co-founder of Inteletravel. Of course, a closer look at where people are going and not going, particularly on the heels of those earnings results that we just got out of United. When we come back, we continue to focus on tariffs and to wish the World Trade Organization a happy birthday. And we're going to pose the question, Scarlett, of whether this year's celebration may be its last.
Was the U.S. funding it?
This is Bloomberg. All right, let's take a look back in history to 31 years ago today, when more than 100 nations agreed to sign the Marrakesh Accord that established the World Trade Organization. It was the culmination of 8 years of negotiations over international rules for economic activity, negotiations designed to extend and broaden that 1948 General Agreement on Tariffs and Trade. That GATT framework of just 23 nations was a direct response to the ravages of 2 world wars and a nod to the ideal that isolationism sowed geopolitical strife, that nations interconnected economically had more incentive to act peacefully. Now, GATT mainly dealt with trade in physical goods, while the WTO expanded on that framework to also include things like tech services, inventions, designs, ideas. Within years, the WTO membership had swelled to include 166 of the world's 195 nations, becoming the de facto arbiter of global trade disputes. However, that dispute resolution was far from perfect. It often took years for the WTO to even make decisions that were often challenged and in some cases ignored altogether. The ascension of China to the WTO in 2001 and the subsequent offshoring of more than a third of U.S. manufacturing jobs, well, that soured public perceptions of the trade body and its ethos. U.S. disdain reached a boiling point during the first presidency of Donald Trump, who in 2019 began to block appointments to the appellate body that hears those trade disputes, effectively hamstringing the WTO's ability to function at all. Last year's 13th ministerial WTO conference, that might have been actually the nail in the coffin. It produced little, if any, change and brokered little, if any, consensus. Effectively, most nations had already moved on, taking cues from the 2 largest economies, which were increasingly re-embracing protectionism rather than free trade. Now today, it's proving to be a critical turn inward that could kill off the last of the bulwark multinational institutions that were built to stabilize the global economic order, a global economic order that the U.S. actually helped to architect, and now a global economic order that the U.S. is helping to demolition.
And it feels increasingly like WTO is a dirty word in 2025. All right, let's stay with this idea of trade and tariffs, because earnings due this week from chip giants Taiwan Semiconductor and ASML are coming out as investors look for clues on the extent that tariffs have impacted the chip sector and whether concerns over future AI demand are warranted. Joining us now for more is Daniel Newman. He is CEO of the Futrim Group. And Daniel, we're just talking about United Airlines and how it reported earnings, but in a very new move, it has given 2 different scenarios. One is what it sees happening for the full year, and then one in a recessionary environment should the economy really, really deteriorate. I wonder what it's going to be like for chip companies and their ability to kind of give some kind of outlook for what they expect. Given their complex supply chains, they have more than just two scenarios, don't they?
Yeah, given the demand the market has to get guidance, to have guidance, versus the no guidance and what that sort of means to the world, having the CEOs come out and say, well, there's 2 or 3 different scenarios. And by the way, your point, there's many more scenarios being played. I'm talking to many CEOs of large cap, mid cap companies, and all of them are pretty consistent in telling me that they're running through a vast number of scenarios every day. Mm-hmm. And by the way, a single post on X can literally change. And so they're stuck in this no decision situation where they all believe in the end we will end up in a good place. That's the good thing I'm hearing from CEOs. But they're all in a situation where they don't know if they should be hiring. They don't know if they should be making CapEx investments. They don't know what country to move manufacturing to. So if the market wants guidance, they're going to have to expect some diversity in the guidance they're going to receive.
What were they willing to share with you in terms of how they're thinking about presenting their various options to investors?
First of all, it very much depends, Scarlett, on what type of company it is. If you're a manufacturer of PCs, devices, iPhones, the type of guidance that they're going to be able to give is going to be incredibly limited, or it's going to require, to your point, some type of scenario that could be good, bad, and somewhere in between. Some of the other companies, like enterprise companies, software companies, there's no tariffs yet on software, on services. The enterprise AI play, you've heard the reaffirmation of guidance from Sundar Pichai, from Satya Nadella. If you're in the AI space focused on the enterprise, I think this last quarter should be very good. And being able to look forward, I think there's still a lot of belief that the future, bringing down OpEx, creating a situation where productivity gains come quickly out of whatever short-term, mid-term recession we might face. Those companies are the ones I like the most right now. Enterprise, software, AI, staying away from consumer and lots of components from China.
I am curious, though, whether we see an acceleration in some of those efforts, in terms of finding ways to increase productivity, whether it's through AI or other technological means, because it's not just about moving supply chains itself. I mean, there is sort of a labor component of all this that these companies are having to confront as well.
Absolutely. Underneath every one of these companies, it doesn't matter if it's handbags from, LVMH or if it's a United Airlines, all of these companies are built on sophisticated technology stacks. They've already been trying to automate and optimize. AI is incredibly deflationary. I've seen it 3 times in just the last 5 years. In the COVID era, there was a big acceleration towards e-commerce, towards more automation. In 2022, when we started to see quantitative tightening, there was a lot of concerns. Markets got crushed. Companies leaned hard into the beginning era of AI and analytics in terms of building software that could allow us to reduce OpEx. From 22 to 24, Romaine, we actually saw the Mag 7. Most of those companies, headcounts didn't increase, but their earnings did.
Well, yeah, and that was a huge story, right? Because everyone, when they started making those cuts, everyone was like, oh, this is ridiculous. You're going to kill yourself. And then, of course, we saw the bottom line and we saw that revenue growth still continued. And it was like, oh, we can do more with less. It gets to the question, though, too, about uncertainty and how you charter a company in such an uncertain environment. I mean, let's just take Apple as an example. I mean, we know there was backroom negotiations to get what we thought was an exemption for smartphones, but then just hours after that, you had certain cabinet members come out and say, well, no, we still got the tariffs on chips, which are inside the phone, so technically they're not off the hook. So how do you even plan for that?
Well, I know a large part of the audience probably really hates references to the art of the deal. But if you actually look at the 145%, now it's 20% or roughly was where it actually ended up. It actually looked like it was some big, massive tariff, and now it's a lot less, and the market actually took Apple's stock upwards from there because there's a belief that Apple can probably figure out how to optimize and maybe pass some costs through, but not all the costs, and phones wouldn't be $1,200 more, they'll be maybe $100 more. Having said that, though, I want to get a little constructive, and I believe to what you said there, Romaine, is that one of the best things the Trump administration could do is actually start giving some clarity, some clear guidance, talk about guidance, clear guidance to the companies that are saying, hey, it's NVIDIA, I'm going to do $500 billion here in the U.S. AMD came out and said they're going to do more here in the U.S. NVIDIA, and then now you have Apple. You name company after company. What is the benefit because they're going to start weighing whatever tariff is versus reshoring versus waiting out 3.5 more years, that there might be a tide turning, a new administration that will roll a lot of these things back.
Talk a little bit more about these announcements to bring, to invest in the U.S. and build some kind of facility or manufacturing capability in the U.S. What does that actually look like? Because the president has made clear he wants to bring U.S. jobs back or create U.S. jobs. These are going to be jobs that are heavily automated, right? Or rely on a lot of expensive and big machinery that 100 years ago would not have.
Yeah, first of all, I think the idea that we would bring back screwing in little iPhones and manufacturing handbags here, I don't think that's what's going to happen here. But the $2 trillion that did go into China, plus to build world-class, leading, innovative facilities for manufacturing, we do need some of that here. Again, kind of being constructive as to what needs to happen, we need to get IP under control. We have completely offshored the entire leading edge. And if we believe that national security is economic security, AI depends on these chips. Most are being made in Taiwan, and the China-Taiwan conflict is real.
But how does that sort of dovetail with some of the administration's moves? I mean, the idea that they would give an exemption for NVIDIA, and I know it's not the Blackwell chips, but still the chips that they exempted are still pretty high powered. And we already know China is just buying those things up as fast as they can, with the assumption the spigot's going to turn off at some point.
Well, they exempted the H20, which is far from the horsepower of Blackwell. But yes, we saw with DeepSeek. We can debate how much that actually impacted the speed. Having said that, innovation will win. And part of this whole scenario has to be, we have to bring back manufacturing, we have to lead in innovation. Because if we're trying to use protectionism as the only vehicle to stop a country with the resolve and ambition of China, I believe we will lose. If we invest here, build here, bring the IP here, because we're also so dependent on Taiwan for the IP to make these chips. So them just building a fab here doesn't fix the problem. We have to bring the IP back to the U.S. as well.
How much talent is there to do that in the U.S. right now? There's a crackdown on universities. A lot of international students are fleeing the country or not able to get in or worried about being able to get a job here.
I believe this is the part of immigration that really requires us to look hard. We should be really opening up the best and brightest. That's what made this country great. I stand by that belief. We don't have the talent here. We would have to bring it over from Taiwan, from India, from different parts of Asia. But I think we have the ambition. We start bringing the jobs, make them worthwhile. We definitely have the education here. People want to come here to study. They want to work for great companies. And the U.S. exceptionalism is real. We have great companies building great things. And I do believe people will want to be here as part of that.
All right, it's a great place to end it. Dan, always a great conversation. Daniel Newman, CEO of the Futurum Group there. A closer look here at, well, maybe, Scarlett, what to expect when we start to get those tech earnings next week.
All right. And of course, we're going to start things off with TSMC when it does report as the leading edge of those tech earnings. Let's also get you some big movers in after hours trading. The airliners are all gaining, and led by United, up almost 7%. It did something unique here in giving its guidance. It gave a one full year adjusted EPS outlook, and then it gave another one in a recessionary environment, which is new because up until now, companies had either maintained their guidance and said they were excluding the impact of tariffs, or they would just pull their guidance completely, saying they had no visibility.
I mean, look, I feel for them. I mean, this is not really the type of job that I think a lot of these folks signed up for, but it's a job they're going to be stuck with at least for the next 3.5 years. We'll be back in a moment. This is The Close on Bloomberg.
U.S. retail sales are due out tomorrow at 8:30 a.m. and the team over at Bloomberg Economics writing the data isn't likely to show any pullback in March as consumers continued front-loading purchases of goods and cars ahead of possible tariff-driven price hikes. Anna Wong of Bloomberg Economics joins us now. And Anna, we're expecting a pretty big number here for the month of March compared with the month of February.
Correct. We're expecting a 1.3% increase in headline retails. And for control group, which excludes cars and gas and the volatile stuff, we're expecting a 0.7% increase. And I think this is broadly consistent with the Chinese exports data that we also had seen a couple days ago, which show that China's exports surged in March. I think all this is suggesting that consumers are front-running the tariffs, and even detailed high-frequency data suggests that consumers are basically buying a lot of the supercenters, appliances, whereas they're cutting back on travel and airfares and hotel spending.
Anna Wong over at Bloomberg Economics, keeping an eye here on what could be a very consequential report tomorrow. Those retail sales numbers out at 8:30 a.m. Washington time. But as she pointed out here, a bit of a skewing of that data, Scarlett, as a lot of the pull forward here maybe not going to be reflective of what we get in the months ahead. Meanwhile, some other things that could move the market over the next 24 hours. We start in the world of politics. Remember Joe Biden, Scarlett?
I haven't seen him in a while.
I know, he used to be president. Of course, he left office on January 20th. We really haven't heard from him since. He's actually scheduled to give a pretty big speech in just about an hour.
Yeah, it's going to be on Social Security. So there's a lot of interest in this, of course, especially as Doge has also targeted its sights on the agency. So that will be a consequential speech later tonight.
And of course, Anna was just talking about the issue going on with regards to the Chinese consumer. We're actually going to get some releases out of China on first quarter GDP, industrial production, and of course, retail sales.
Yeah, so it's a bit of a data dump out of China, and it could set the tone in terms of how China is faring, the economy overall, or at least how they would like us to think the economy is faring, given all the turmoil between the two countries.
Yeah, and I'm really curious to see kind of whether this becomes a tale of two cities, or between the U.S. and China, or whether this is kind of like we're all in the same boat together and we're all either going to prosper together or suffer together. We are going to get some earnings tomorrow that really could move the needle, including from a key chip maker.
ASML, which is basically the main chip company out of Europe, it will be reporting earnings. And we also have Kinder Morgan here in the U.S., Heineken out of Europe as well, also very much affected by tariffs. CSX and Alcoa.
Well, maybe we'll be drinking more given all the turmoil.
I know I will.
So, retail sales out at 8:30 a.m. We were just talking about that. Definitely something to keep an eye. Team surveillance. We'll have full coverage of that. 8:30 a.m. out of Washington. And we're actually going to hear from the man himself, the Fed Chair, Jerome Powell.
He will be speaking at 1:30 p.m., and this could account for some of the low volume that we saw in the Treasury market, in the equity market, because of this speech. Again, he's not going to say anything that's vastly different from what he said in the past. The Fed's in wait-and-see mode. They don't have a comment on fiscal policy, but it'll definitely be his tone and, just his overall demeanor.
Yeah, and I think it does give a chance. It'll be interesting. Obviously, a lot will depend on what types of questions are asked of him, and we still got a ways before we get to that May 7th Fed decision here. So I don't know. Maybe his tone's changed since the last time we heard from him. Maybe
Could
not.
be. I mean, there's a lot of turmoil, so, maybe he'll say something about...
By the way, did you borrow that jacket from Jensen Huang? I love it. I love it.
If only I could be Jensen Huang.
Balance of Power is coming up next. Stick around. This is Bloomberg.